Hi, everyone, and welcome back to AIADA's AutoTalk. I hope you've been enjoying your summer. I'm your host, Rachel Soleimani. A few quick reminders. Anyone who is registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today, we welcome friends from Bakertilly, Dan Cheney, Sector Leader, and Trevor Dubois, Tax Senior Manager. In case you missed it, in June, MossAdams and Bakertilly merged to create the sixth largest advisory CPA firm in the US. So it's been a pretty exciting and busy summer for Dan and Trevor. But with that, I'll let you guys take it away.
Thank you, Rachel. It has been a pretty exciting summer. We have dealers and now thousands of dealers in every state in the union. So it's a very important thing for us. And this is a fun webinar for us because it's one of those times that we get to talk about some good news on the tax front. And so a lot of times it's not as good of news, but I think there's some pretty good stuff to share today. What we try to do is synthesize it down to just kind of the most important things for you to know, and we'll try to make it quick and efficient information sharing. So Trevor, maybe the next slide, I'll share some the agenda. So today we're going to talk about the key business tax provisions, and then we're going to talk about some of the bad news, which is loss of some of the energy tax credits that were in place. And then we'll go into the individual provisions and some estate tax provisions. So maybe real quick introductions. I'm Dan Cheney. As Rachel said, I lead the sector for the new combined Bakertilly firm for automotive and dealer services. And I grew up in a family of auto dealers and spent the last 30 years pretty much just doing this. And Trevor, I'll let you introduce yourself.
Yep. Thanks, Dan. I'm Trevor Dubois. I'm a tax senior manager here in the Pacific Northwest region. Been working with dealers for almost 10 years now and get the opportunity to work with Dan pretty often in several large client groups. So excited to be here and present to you guys. I'll go ahead and move on. So real quick before I move on, quick reminder on the tax bill that passed back in 2017, known as the Tax Cuts and Jobs Act, or TCJA. Pretty high level here. That act reduced overall tax rates, created a new 199A QBI deduction. However, these two items, the tax rates and the QBI deduction, were set to expire at the end of 2025. A couple other large items that it created were the 163J interest limitation, and as well as the SALT cap limit for itemized deductions. So now let's move on. We'll discuss some items on the One Big Beautiful Bill Act and how that affects the items we just talked about. So first of all, as I just stated, the QBI deduction was set to expire after the 2025 tax year. The One Big Beautiful Bill Act extends the QBI deduction permanently. I'm going to say permanently in quotes. It's permanent until some other law potentially changes that. There's also a couple other items that it adds starting in 2026. So there used to be a phase-in or phase-out range for QBI income to be limited to W-2 wages or UBIA, as well as a phase-in range for specified service trader businesses. That range was only $50,000 for single and $100,000 married filing jointly. It's now $75,000 for single and $150,000 married filing jointly when you look at that range. There's also a new minimum QBI deduction of $400 that's allowed. So when you run through your calculation, if you have a loss for your adjusted taxable income that wouldn't have typically allowed a QBI deduction, you now can still get at least a $400 deduction if you have QBI over $1,000. And these both apply starting January 1st, 2026. So again, the old law was set to expire 25. New law starts January 1st, 2026. This QBI extension is huge because it basically keeps tax rates down at 29.6 for dealership who are flow-through entities. Whereas if this law wasn't extended, it would have gone up to 39%. So effectively, it would have been about a 33% increase in 2026 tax years if it weren't for this extension. So quick chart here just to kind of highlight what I talked about there with the tax increase. So 2025 under TCJA, again, you would have gotten your QBI deduction of 200,000 on $1 million of flow-through income, assuming you met the wage and UBI limitations. So taxable income of 800,000 times a 37% rate, tax would have been about $300,000. 2026 under the expiration of TCJA without the one big beautiful bill fix, that QBI deduction would have gone away and tax rates would have gone up to 39.6, so almost 400,000 of taxes. That's that 33% increase over the 300,000. Now back under the one big beautiful bill act, we're the same as where we were before for the last 8 or so years. Another big modification under the one big beautiful bill act is the modification of business interest deduction limitation, or section 163J. So back when TCJA first passed, large companies that met the gross receipts limit were subject to this 163J limitation. And for the first few years, you got to use EBITDA when calculating your adjusted taxable income in this calculation. And then for the last few years, it was just earnings before interest. So you only got to add back interest expense when getting to your adjusted taxable income. Now under one big beautiful bill act, we're back to the EBITDA. So starting in 2025, you're going to be able to add back interest, depreciation, and amortization in your 163J calc to get to a new adjusted taxable income number. This is great news. Over the last few years, as interest rates have gone up, we've seen more clients have a limitation when it comes to interest. So adding back depreciation and amortization should be a welcome sight to many businesses. Another new item, there were some professionals out there that were kind of doing a workaround to try to not have such a large limit on interest by capitalizing interest through a capitalization policy. They kind of came out and said you can't do that unless it's under these two sections here, 263J and 263AF. Another new welcome sight for dealers who might have more than just car dealers, motor vehicle and floor plan interest now permanently modified to include certain trailers and campers as well. So if you are limited on your first initial calc and then you're going to allow all your floor plan interest, now if you're a dealer of anything besides cars that are trailers and RVs and stuff like that, you now get to include that as floor plan interest and allow that deduction. So as you work through starting 2025, consider how the more generous ATI calculation will impact your limited interest carry forward from prior years and incorporate it into your projections for year end. Another quick chart here. So I'll do my best to keep this as straightforward as possible, as this calc and limitation can be pretty confusing. So the first column under 2025, we're assuming we had 600,000 of assets placed in service, and bonus depreciation on that's 100%. So our taxable income before depreciation would have been 750. We have 600,000 bonus depreciation that gets us to our 150,000. We have interest expense on the year of 300,000. And then again, under TCJA, we'd no longer get to add back depreciation and amortization. So your adjusted taxable income is 450,000. You multiply that by 30%. Your interest allowed for the year would be only 135,000. So the 300,000 in excess over the 135,000 means that our interest would be limited by 165,000. As a dealer, when your interest is limited, you no longer get to take bonus depreciation. So we go over to column 2. So what does our taxable income look like now without bonus depreciation? Well, that difference there with bonus would be about 600,000 of depreciation. Without bonus, it'd be about 120,000 of depreciation. So we're adding back 480,000 to our line 1 taxable income number there to get 630. Again, we add back interest expense, still no depreciation, amortization add back under TCJA. Our adjusted taxable income is 930,000. 30% of that 930 is 279,000. So we still have an excess business interest expense of 21,000 on that calculation. So taxable income on the return would be the 630 plus the 21,000 disallowed interest, so about 651,000 of taxable income. Now we go back to the update under One Big Beautiful Bill Act, and we get to add back depreciation and amortization into our ATI calc. We start back with the 150, assuming we take all bonus depreciation, interest expense of 300,000. We get to add back the depreciation of 600,000. Adjusted taxable income is now a little over $1 million. That 30% limitation is 315,000. We are no longer limited. Therefore, we don't have to opt out of the bonus, or we no longer don't get to get bonus depreciation. We still get to take it. So our taxable income under this new law would be 150,000 versus 651,000. So super good benefit there for dealers and flow through entities and C corps actually.
Just a comment there, Trevor. I mean, that's a $501,000 benefit. And in this example, we're just using like a cap loan interest example. So
yeah,
there's no floor plan interest. Let's pretend that they own all the inventory for this example. But just to highlight, interest is still limited under the old example, even after taking away bonus depreciation. So it really, that being able to add back that depreciation is just so significant.
All right. Another new welcome sight for a lot of dealers is the bonus depreciation. So starting a few years ago, bonus depreciation started getting phased down. So it was 80% bonus, then 60% bonus, and 40% bonus. Now under the One Big Beautiful Bill Act, we're back to 100% bonus depreciation for assets that were purchased, and I want to highlight it's purchased and placed in service. So it has to be purchased after January 19th, 2025 as well. That's just the inauguration date. So the date after he took office, we're getting 100% bonus depreciation back. The 179 expensing also is expanding. This is pretty common for this to happen kind of every few years. So you can currently expense up to $2.5 million of qualifying property, with phase outs beginning at $4 million of assets placed in service. And this is effective after starting 2025 for 179. So planning tip, consider how these retroactive changes impact your 2025 projections and quarterly estimates. Monitor state conformity. So as you may know, those who file in states, they don't always follow bonus depreciation or 179 expensing. So just make sure when you're doing state projection planning that you're considering that as well. So here's a quick chart, like I mentioned. So for 2018 through 22, we had 100% bonus depreciation. 23, it was phased down to 80%. 24, 60%. It was supposed to continue down 40, 20, down to 0 starting in 2027 based on TCJA. Under the One Big Beautiful Bill Act, we're back to 100% accelerated bonus depreciation starting in 2025. And this again is also permanent, assuming no further law changes pass. All right, Dan, I think you're going to take the next few.
Yeah, and that permanent 199A, you've already said it, but I think it's worth emphasizing that 199A, that 20% deduction, was going to expire. It's permanent now, and bonus depreciation at 100% is permanent now. And so that requires an act of Congress, where the reason why we're seeing an act of Congress right now is because these things, we had a cliff coming, and these things were going to expire, and there's no expiration built into this new law. So they're permanent, and it will take an act of Congress to take them away. So those kinds of things are just super important. We put a slide in here on opportunity zones. Opportunity zones, we'll make it kind of short, but just if you think about like a lot of real estate 1031 exchange planning, where people will roll the gain into the new property, opportunity zones allow you to roll capital gain into a fund, an opportunity zone fund, and defer the tax. And if you keep it over a 10-year period, have kind of no tax on that gain. And so that law was set to expire at the end of 2025, and it has also been made permanent. So we're seeing some activity. It's really doing a development or a project in certain areas, kind of depressed economic areas, funding those things with current capital gain money, allowing for an additional deferral. So that's an exciting extension that we'll probably see more impact coming from. Next slide.
Yep.
Another, this is kind of, I guess, on the not as positive side. There was some limitations put on C corps. Executive compensation, this $1 million deduction limit for large C corp executive compensation, and then the charitable contributions that large C corp. So we're not talking about pass-through entities that most dealerships operate in, but some dealerships do operate in C corp structures, and then publicly traded, obviously, almost all are C corp structures. So 1% floor on charitable contributions. So 1% of the taxable income before charitable contributions start becoming deductible, and so that's kind of a give back of revenue to the Treasury through those two things. The new markets credit has been made permanent, so that's another one of those permanent benefits, and we're really excited about that. Advanced manufacturing incentive credit. This is just really building manufacturing facilities in the U.S. It's a big incentive and a credit to do that. Not as much of an impact on dealers, but something to be aware of because we'll see a lot of activity by the manufacturers. And then some changes to the credits for paid family medical leave, making some of those permanent, and a little bit of a change in the way they're calculated. A few of the things that are what kind of dodged bullets in the not included in the new bill, there was a lot of discussion, and it almost came down to the wire on this, where the limitation on deduction for state taxes. The workaround that many states have implemented is to have pass-through entities pay those taxes and take a deduction at the pass-through entity level, and then pass the credit up to the shareholder to offset their income from the state. That ended up surviving the bill, which was really good news. And then there's no new higher tax on AGIs over $1 million, which was something that was talked about being included in the bill. And no change to the corporate tax rate, remains at 21% for C corp rates. Again, most dealerships are pass-through entities, but for the ones that are, they did not change the C corp tax rate or the capital gain tax rate. So it's kind of nice to see those changes not occur in the bill. So we're going to talk a little bit about the scale back of these energy tax credits and the way they're raising some of the revenue to offset the deductions or lack of revenue from increased tax deductions. They've really cut back on all or most all of the clean energy credits that were included in the Inflation Reduction Act, including accelerating the phase out of some of the wind, solar, and electric vehicle credits, and we'll get into those. So you probably are super aware in this business of the 30D credit expires on September 30th, 2025. We've got a little over a month until that credit expires. And the one that was more commonly used is that 45W lease vehicle credit, also expires on September 30th. And the credit for previously owned electric vehicles expires on September 30th. And we are concerned that whether the infrastructure will be in place to claim these credits after September 30th. So we think it's really important for dealers to ensure they've submit their claims, on the portal before September 30th, and as of the last day, September 30th, for vehicles they sell for those credits especially for the 30D credit. We think that's going to not live very long after. We don't know for sure, but that's a concern. And then for the alternative fuel, basically your charging station credit, that expires after June 30th of next year, so June 30th, 2026. So if the charging station is placed in service before June 30th, you'll be fine, but it needs to be placed in service. So construction complete and placed in service by June 30th, 2026 to get that credit. So that's another give back. So this is another one that a lot of dealers may not be aware of, but there's this deduction. It's a 179D deduction for building an energy efficient building. And depending on whether it meets all the criteria, you can get up to $5.81 per square foot of credit or a deduction for building a facility. It's important to know this ends on June 30th, 2026 as well, but that just is for property where construction begins after June 30th. So there's still potentially a few years left on this deduction for 179D for building the energy efficient building, as long as construction begins before June 30th, 2026. I think, Trevor, I'll turn it over to you to talk about some of these individual and estate tax provisions.
Perfect. Thanks, Dan. All right, so some key individual tax rate changes. Like I mentioned kind of on the first few slides, TCJA, the income tax rate reduction, was set to expire after 2025. So that max tax rate was going to go back up to 39.6%. The brackets were going to be adjusted a little bit, and overall tax rates were going to be a little higher. One Big Beautiful Bill Act extended those tax rates that TCJA started. So we're back to a 37% max rate and adjusted some of the rates throughout the brackets. And that is also currently a permanent change starting 2026 or continuing into 2026. The SALT cap. So we talked about TCJA created the SALT cap for itemized deductions of $10,000 back in 2017. And like Dan mentioned, that's when a lot of the states came out with that PTE or pass-through entity deduction / credit that you could do for flow-through entities. The One Big Beautiful Bill Act increases that SALT cap to $40,000 initially for 2025 and will be adjusted annually for inflation through 2029. It will revert back to $10,000 starting in 2030. So this is just a few years, a temporary change to $40,000. However, there is a limit to that $40,000 for high income tax earners. So people who make over $500,000 married filing jointly will be phased down by 30% to that $10,000. So high income earners likely might still have the cap back to $10,000 for the next few years, and no change seen there on their itemized deductions. But continue planning for those flow through owners, continue planning those PTE deductions for state credits and taxes. Some estate and gift tax changes. So 2026, I guess back to 2017, they doubled the exemption for your estate filing. And in 2026, that was set to go back to 50% or back to what it was before. So basically getting cut in half starting 2026. So there was a ton of attorneys and CPAs working diligently to get some of this estate planning done before the end of the year. Well, now it's permanently extended as of right now. So, and adjusted for inflation. So we're back up in 2026 to 15 million of estate exemption per person and 30 million then for a couple. So one thing to pay attention to though going forward is state changes. Washington specifically, like I mentioned, I'm from the Pacific Northwest region. So Washington has gotten worse when it comes to estate taxes. So just make sure you're also paying attention to that and where you are a resident of or plan to be a resident of for the future. Any other thoughts there, Dan? This is a pretty big deal that they kept this doubled.
It's amazing. And I will say that typically a lot of the estate planning that happens is because of the pressure of this, a sunset on these high exclusions for estate tax purposes. I think it's really important for dealers to not take it for granted that we have this opportunity with a $30 million exemption, index for inflation, to do the estate planning that needs to be done, both because of state law changes and, you just don't know what the future holds, even though these laws are now permanent. that just means until the next Congress decides to change them. And so I think there's a lot of people are working hard towards goals by the end of 2025, and I would say keep the foot on the throttle for that.
Definitely. Okay, I think you're finishing up on the last few slides, Dan.
Yeah, and so these last few items, the tip income and overtime income deductions, those were promises from the campaign trail that they've included. They are phased out, so these things not phased out, sunset. So these are kind of like we talked about 199A earlier and some of those other bonus depreciation items that they made permanent. They did not make these permanent. So after 2028, they go away. But it does allow for a deduction against tip income for people that make under 150,000 or 300,000 married filing jointly. And then for overtime, it's a deduction up to 12,500 of overtime compensation. It's only the deduction related to, like, if you're paid time and a half, that half that's overtime time. And it also phases out over 150 and 300,000. And then there was a promise of kind of for elderly people, Social Security not being taxable. The way they accomplished that was having a deduction for eligible seniors that make under a certain income that really kind of offsets that Social Security income tax by providing that senior enhanced deduction. And then the one that's probably most interesting to this group is this car loan deduction. It's pretty narrow who qualifies under 100,000 in income, up to 10,000 in interest on a auto loan, and it's only available from 25 through 28. So there's a few good provisions built into there.
Yeah, one thing I just want to highlight real quick, Dan, too, is the tip income, overtime income. It'll be kind of the employers need to track that, and it's gonna have to be provided on the W-2. I don't know if it'll be a new box or line item or what it's going to be, but it's got to be a separate call out on that overtime and tip income.
And that is for 2025, so they need to be tracking it kind of now. Charitable deduction, there's an additional for people that do not have, meet the itemized deduction threshold and so they're non-itemizers. There's an allowance for some above the line charitable deduction after 2025, and then it's also a limitation for itemizers on charitable deductions that's built into the law. And they did permanently get rid of what was known as the P's limitations. That hasn't been around for several years, as part of the Tax Cuts and Jobs Acts. I'm happy I haven't had to say one big beautiful bill as many times as Trevor has in his slides. But we got rid of the P's limitations permanently, but they put in this new cap that requires some math and I think one thing to pay attention to is if you're going to make a big charitable contribution, this might be the year to do it before these new limitations go into effect. Anything to add there, Trevor?
The above the line charitable deduction that was brought in during the COVID years. So non-itemizers got like up to $300 or $600 deduction above the line, and it was super popular. So I think that's part of the reason they brought that back, and the amounts are higher. And then the limitation, the new limitations on high income earners. So if you're going to be in that 37% tax bracket, you are going to have a limitation on your itemized deductions, and it's basically at a 2% tax rate. So you only get a 35% benefit versus a 37% benefit.
Makes permanent the increase in the child tax credit, which is helpful. Phase out start at $400,000 for a married couple and $200,000 for single. extension of the standard deduction. So if you remember, we got rid of personal exemptions as part of the Tax Cuts and Jobs Act, and that's made permanent. So no longer having personal exemptions, but the way they compensated for that was increasing the standard deduction. So now it's also permanent for the increased standard deductions, and so that adds up to 31.5 of standard deduction for a married couple. AMT permanently extends the increased AMT exemption. We haven't seen a lot of AMT. That's the alternative minimum tax in the last several years, and it's now permanent, that change in the way that's calculated. So that will help a lot of people as well. The limitation on casualty losses is also changed, and the mortgage interest deduction, $750,000 deduction, it was set to go back to $1 million. Now it's set at $750,000.
Okay, so what's next? I'll wrap it up here. Time's about done. Definitely be working with your advisors and CPAs. This wasn't an all-encompassing update on the One Big Beautiful Bill Act. There's lots of other changes and updates to other itemized deductions, qualified small business stock exclusions on gains and stuff like that. So just make sure you're staying in touch and running projections for what this is going to look like for you going forward. Consider any other potential impact on transactions or expansion plans as well. Evaluate capital expenditure plans, especially under the new bonus depreciation. There is a new manufacturing accelerated depreciation deduction that you can get if you're building a manufacturing plant. And then lastly, like we mentioned kind of before, you definitely want to stay informed on your state and local tax law changes. They are changing quickly and typically very aggressively. So definitely stay up to date on your state and local tax stuff as you move forward, and the conformity that those states will have with the One Big Beautiful Bill Act changes. I can't see any questions or anything like that. I think we're close to time. Are there any out there, Rachel or Dan? I can't see the Q&A.
None that have come in, but if anyone has any, feel free to pass them over to me and I can send them to Dan and Trevor for you.
Perfect.
Dan and Trevor, thanks for taking time out of your busy schedules and summers to share this presentation with us today. This is some great information and very helpful to a lot of our dealer members. Again, you'll all be receiving a copy of this presentation and recording by early next week. To those on the line, join us back here on Thursday, September 11th at 2 p.m. Eastern as Cox senior economist Charlie Chesbrough kicks off our fall series of webinars with his real-time market update. So be on the lookout for promotions. To learn more about AIADA, visit aiada.org. Thanks for joining us and have a great day, everyone.